We are slightly more bearish, I think, at Aberdeen Portfolio Solutions than the consensus. So we still think that Europe and the UK are heading into recession imminently, and that recession will come for the US. Maybe not as deep as we thought it would be, but certainly the US should slip into recession by the middle part of next year. So with that, we're buying treasuries at the moment. We've switched some of our portfolios from high yield to treasuries. We believe there's actually a lot of value now at the short end of treasuries. And along with that as well, we see value in UK small caps, which is a bit of a non-consensus trade at the moment. We have very little in that area. We think actually the growthier side of the market now, if we do see rate cuts coming across in the UK, could really be good.
If UK small cap, absolutely not consensus, because if the thing's going to hit the fan, proverbially, then small caps is normally where they bear the brunt because of their cyclicality.
That's true. So we want growthier small caps rather than more value-orientated small caps. We think actually that's the sort of market to be in at the moment. When there's blood on the streets, you should start buying. And we think actually small caps are always cheap, it seems, especially UK small caps certainly are. But actually, on a historical basis as well, we are extra cheap at the moment, so we're going to dip our toes back into that.
Still game in terms of the cycle, but I want to press you on treasuries. I noticed that you said the short end, and obviously the 10 is where we've seen a lot of movement to the point where a big traders on the fixed income market saying we're closing out in bearish shorts here. We think that there's so much risk out in the world environment, and Bill Ackman being one of them, that it warrants revisiting. But the 10-year, I mean, one other version of this, and this was from State Street, saying, look, there is no anchor in US Treasuries. So it means we're adrift on bond markets, right? That's dangerous territory to be adrift at this point.
It's very dangerous. We believe on the short end, so 2 years, for example, there's actually value to be found there. So the hopes and expectations, I guess, for the Federal Reserve and other central banks are sort of anchored at the moment. I don't think markets are expecting the Fed to raise rates any further. They could certainly hold them higher for longer, but we think actually expectations have anchored yields on the short end.
But not on the 10. And what is it going to take to anchor the 10-year? Because the market is saying, look, until you see that pressure come off the 10-year, you're not going to see any appetite for stocks.
I think we'll need to see a lot more weaker data coming out of the US. I don't think we'll see that with those GDP figures this afternoon, but hopefully as we get towards the new year, you can see cracks appearing in the labour market. And we saw PMIs as well this week as well. Not exactly strong, more mixed. We need more data like that, I think, for bonds to settle down.
What's going on in high yield world? Because, and I know you've got a view on this one as well, but when I look at, there was a great story, I think it was the Financial Times earlier this week, talking about the expansion of yields on European high yield rather than the expansion of yields on US junk, high yield stroke junk, i.e. it's picked up because of the extra strain on those companies and the refinancing in Europe more aggressively than it has in the States. And it's something I concur with, actually, because I spent a lot of time looking at the high yield index in the States, and we only seem like we're a long way away from the peak crisis kind of levels that we saw in the GFC and we saw at the turn of the century as well. So I think you perhaps concur that actually it's not the right time to be buying US high yield.
Yes, I think it's pretty much overvalued at the moment. It's had a good run compared to other fixed income markets. And actually, we believe, as I mentioned earlier on, but now treasuries sort of offer a similar yield to those. And actually, they obviously a lot safer. So we believe that treasuries are sort of a way to go in terms of value at the moment.
When you say similar, I mean, I think the average high yield, the index is showing about 8.99% at the moment, whereas the treasury is not quite that level.
Not quite that level, but the gap is certainly close. So we feel for that premium that actually treasuries are the way to go at the moment.